Welcome to the deep dive. We've got a really fascinating mix of sources today. We're seeing markets, really trying to figure things out amidst some deep uncertainty. Stuff like the political mess in Washington, but also like the economics of high-tech AI chips. So our focus today is cutting through those headlines. We want to find the bigger shifts happening when all this macro chaos hits industrial evolution.
Exactly. And our mission here is to help you connect those dots.
Yeah.
Because, how does gold hitting a crazy record like $4,000 an ounce connect to how consumers are feeling? And then how does that instability shape where big money is flowing? Think private assets, think tech profitability, or lack thereof. We're really digging into the why. Why this risk aversion now?
Yeah.
Why this hunt for yield?
Okay, let's get into it. We really have to start with the big one right now, Washington. The U.S. government shut down. It's now, into its second week?
It is, yeah. And the effects are, immediate and pretty systemic.
Yeah.
The most obvious thing is this kind of information vacuum it creates. Key economic data, like the September jobs report, which everyone watches, it's delayed. So we don't officially know what's happening. But we did pull some proprietary data from Carlyle, the investment firm, and their internal tracking. It suggests the labor market is slowing down, maybe quite a bit. They think September job growth is probably only around 17,000. Pretty meager.
Wow, 17,000. So when you have that level of data darkness combined with the political instability, the market reacts strongly. Which brings us straight to gold, doesn't it? The big fear signal.
The numbers there are, frankly, just astonishing. Gold prices hitting a record $4,000 an ounce. That puts spot gold futures up nearly 50% just this year alone.
50% in less than a year. I mean, what does that tell you? It feels like more than just hedging inflation, right? This seems like a real flight to safety. Driven by, everything. The shutdown, geopolitical risks, France's political situation, sticky inflation.
That's exactly right. Gold is the classic safe haven, sure. But this level of movement, it signals a really deep lack of faith, perhaps, in government stability in traditional currencies. And strategists are arguing gold is still, under-owned in portfolios. Ray Dalio, for instance, he suggested maybe allocating as much as 15% to gold for diversification. It reflects this whole shift away from that simple 60-40 portfolio model we kind of relied on for decades.
And what's fascinating, I think, is how quickly this high-level financial stuff translates down to, us. Consumer costs. The jewelry industry is apparently sounding a huge alarm. Companies like Majuri, Pandora, Signet, the mid-sized players, they're all feeling the squeeze from rising gold and silver costs. Signet, I saw, specifically mentioned their raw gold costs jumped over 30%.
Which forces them to pivot fast. Yeah, they're raising prices on some things, but mostly, it seems, they're having to dilute the product. Shifting towards 10-karat gold or even gold-plated stuff, just trying to keep things affordable for their, non-luxury customers. So that's the chain reaction right there. Macro instability can mean a lower quality product for you, maybe even at a higher price.
And you see this general unease reflected in broader consumer sentiment, too. The New York Fed's survey shows more pessimism. Fewer households think they'll be better off in a year, and they actually expect inflation to tick back up.
Which kind of tracks with those high credit card balances, right? $1.21 trillion in Q2.
Yeah, it all connects. And going back to the shutdown's immediate impact, the human cost, there's growing uncertainty about back pay for all those furloughed federal workers. Now, there's a 2019 law that requires back pay, but President Trump recently suggested it depends on who we're talking about.
Yeah.
So that creates, legal questions and just major financial stress for millions. Right. And analysts seem to be circling October 15th on their calendars. That's the military pay date. The thinking is, politically, failing to pay the, 1.3 million active duty military members? That might just be the one cost that's too high, could force some kind of resolution.
It's a key date to watch. Before we move off the macro, maybe a quick look overseas, because it's kind of the opposite story in Japan. Where the U.S. has gridlock, Japan has, stability. Their Nikkei 225 index hit a record high after Sanai Takaichi's election. Why? Expectations that the Bank of Japan will just keep its easy money policies going. So capital clearly likes certainty, right? Even as the yen weakened past that 150 mark.
That's a great contrast, actually. So this flight from instability, it's not just gold, it's really aggressively reshaping where asset managers are looking for safety and yield. Which takes us to this whole retail revolution in alternative assets.
Yeah, the momentum there, particularly from wealthy individual investors, it's been stronger than expected. Ari's Management is a really good example. They just upped their 3-year fundraising targets by 25%.
Yeah,
a big jump
that's right.
because of this inflow. They've got over $50 billion now just in these semi-liquid retail funds.
50 billion. So when money moves that fast into maybe less traditional areas, the question always becomes about quality, doesn't it? Like, does the wealthy individual get the same deal, the same quality product as the giant pension fund?
Hmm.
The Era's CEO, Michael Arricchetti, he pushed back pretty hard on that idea that retail gets the weaker stuff.
Yeah, he basically said that's just not true.
Yeah.
His argument is that the big managers, they allocate deals based on the capital they have available across all their platforms. Institutional, wealth management, it all gets pooled, supposedly. So the products grow together, quality maintained.
I wonder, though, is it really perfectly equal? Or is there some selection bias? Like, if I'm a huge institution, maybe I have more clout to negotiate fees or get into the absolute best deals, even if the general pool is shared. It just feels like perfect parity might be hard to achieve.
Well, and that's where it gets tricky for the average retirement saver, the regulatory side. Arricchetti himself sounded pretty skeptical about getting these alternative assets into standard 401ks quickly. The big hurdle is fiduciary duty. Since alts often have higher fees, the plan sponsors worry about getting sued. Even if those alts might actually produce a higher net return after fees compared to plain old stocks and bonds, it's tough to justify that higher fee structure in court, apparently, even if the outcome is better.
Ah, the classic tension. Maximizing return versus minimizing liability. Okay. And this hunt for yield and hard assets, it's not just private credit. It's huge in residential real estate, too.
Right.
We saw that investors, individuals, and institutions combined bought a third of all single-family homes in Q2 2025. That's the highest share in 5 years.
A third, yeah. But it's really crucial to break down who those investors are. The small guys, people owning 10 properties or fewer, they still make up over 90% of that investor market volume.
90%. Wow. That really cuts against the narrative you often hear, right? The one about giant corporations buying up entire neighborhoods.
It does. And here's the really interesting nuance. The institutional players, those big corporate landlords, they've actually been net sellers of existing homes for 6 straight quarters. They're taking that capital and instead putting it into building new build-to-rent communities. So they're essentially manufacturing new rental supply, which, changes the whole market dynamic.
Okay, manufacturing supply. Interesting shift. Let's pivot now to the really high-growth frontier AI. Because all that massive spending that fueled the AI boom, it seems like it's hitting a profitability wall.
Yeah, the friction point is definitely the sheer cost of computing power. Oracle is the case study here. Their stock took a hit after reports showed the margins on their cloud business, specifically renting out NVIDIA chips, were really thin, like only 14% gross margin on $900 million in sales. Compare that to Oracle's overall company margins, which are closer to 70%. Reports even suggested Oracle might be losing money on some of these initial AI deals just to grab market share.
Right. But then you hear NVIDIA's CEO, Jensen Huang, saying, essentially, don't worry about short-term margins. He argues it's normal with new tech ramps, and the systems will be wonderfully profitable eventually. Isn't that kind of the playbook that, didn't work out so well in the dot-com era? Are these cloud companies just burning cash to win the AI race, hoping profits come later?
That is exactly the multi-billion-dollar question keeping investors awake. You had billionaire tech investor Orlando Bravo making that explicit comparison to the dot-com bubble. He basically said, valuing a company with only, say, $50 million in recurring revenue at $10 billion, that's a tall order. The math just seems stretched unless you assume absolutely perfect exponential growth for a long time.
Yet, despite those valuation worries, the spending, the AI arms race, it just keeps going at this frantic pace. OpenAI is striking massive deals for compute power, not just with NVIDIA anymore, but now with AMD too. Oh, was it 6 gigawatts of GPUs?
6 gigawatts. And just to put that number in perspective, that amount of power, it's like the continuous energy needed for a small American city. It just shows the absolutely staggering scale of this AI build-out. It's almost hard to comprehend. Jim Cramer pointed out that OpenAI hoarding all this power could actually make the big cloud providers, the hyperscalers like Google and Amazon, quite vulnerable. They might get bypassed.
Fascinating power dynamics. And okay, just finally, looking at other tech areas. They seem to be responding more to the broader market pressures, focusing on affordability again. Another recurring theme today. Tesla brought out cheaper versions of the Model Y and Model 3. The Y is now under $40K, the 3 around $37K. Feels like a direct response to losing that $7,500 federal EV tax credit, trying to pull buyers back in.
Rivian's doing something similar too, right?
aiming for a wider market with their R2 model starting around 45K.
Yeah, it just confirms that even in these hot growth sectors, price still matters. Consumers are clearly sensitive to cost increases and that general macroeconomic fear. It mirrors what we saw with the jewelry companies having to adjust because of gold prices. Same dynamic, different sector.
So, okay, let's wrap up this deep dive. We've covered a lot of ground, a world where investor money is rushing towards perceived safety gold, private credit, even newly built rental homes, basically hedging against political gridlock, economic uncertainty. And meanwhile, the companies in the hottest growth sector, AI, are facing this maybe unsustainable cost structure just to stay dominant.
Yeah, and the common thread running through all of this, for you listening, is really about financial planning. Navigating this kind of uncertainty, this complexity, it really demands that you constantly challenge your own financial assumptions.
Which brings us perfectly to our final provocative thought for you to chew on. Building right on that planning theme. Think about retirement savings. When you're deciding between traditional contributions that's pre-tax and Roth contributions after tax, most people, maybe you too, tend to focus only on their marginal tax rate right now. You know, the rate on your last dollar earned. But that might be a mistake. The potentially smarter way to look at it. Focus on your likely effective tax rate in retirement. That's your total tax paid as a percentage of your total income. Because of how our progressive tax system works, with deductions and lower brackets filled first, your effective rate in retirement could actually be much lower than your marginal rate today, maybe lower than you expect. So thinking about the lifetime tax bill, not just today's marginal rate, that could be the key to smarter long-term saving.
That's a really excellent point. A great distinction, and definitely a powerful takeaway for people to consider. All right, that wraps up this deep dive into chaos, capital, and challenging assumptions.
Thank you for joining us. We'll be back soon with another deep dive into the sources shaping our world.